We can look at the stock market and the recovery is fantastic. In fact, it's better than most had predicted. Then we can look at the economic indicators, hundreds of them, and it's a really different picture. This great disparity hasn't been this wide since the financial crisis. Now, while that doesn't mean a recession will happen tomorrow, it does mean that we must hedge our bets and begin to prepare for volatility and late cycle behavior. You came here for the truth, so let me unveil that for you. Today we're going to do a rundown of different economic indicators. We're looking globally. I want to show you what's happening in the US. We're going to talk about Europe. I want to talk about a lot of different issues. I got charts, I got articles, many things to get into. So let's begin with this. Several ECB policymakers doubt projected growth rebound. Does that surprise anybody? We have negative interest rates, we've got quantitative easing, we've got a policy for just about everything, and it hasn't fixed a single thing. Several ECB policymakers think that the bank's economic projections are too optimistic as growth weakens in China and trade tensions linger, according to these sources, but you don't need to know that. All you have to do is look at what has happened and you will know that for yourself. You don't need to see this type of information out there and they say this guy said this and that. No. Look at the truth, look at the data, and we'll do some of that today. A significant minority of rate setters in the last week's policy meeting expressed doubt that a long projected growth recovery is coming in the second half of the year, and some even question the accuracy of the ECB's projection models given a long history of downward revisions. Every time, and what has been happening is that we've seen it go down, down, down. They've been trying to support it on the way so that it doesn't just free fall, but ultimately the direction is down. And that goes for just about everything that they've been trying to protect. It's only gotten worse. Now this is the US manufacturing production month over month. That's 2 in a row, or 2 out of 3 anyway, that have looked quite dismal. Looking at this connected with the US manufacturing output was unchanged in March after 2 straight monthly declines, resulting in the first quarterly drop in production since 2016. The weakness in manufacturing reported by the Fed is in tandem with a moderation in the broader economy. This is the type of thing we keep hearing about, how wonderful the economy is, and yet the economic indicators do not support that. They do not show that, and that's what I bring to you here. A lot of people want to deny it. A lot of people are not willing to accept the truth, but here it is right for us in front of our faces. Why can't people just understand that the stock market, the S&P 500, and your 7 shares of Amazon are not representative of the real economy? Yes, there are some bright spots. People are still buying cars. People are still shopping. People are buying houses. People are renovating their houses. But look at what they're doing it on. They're doing it on debt more than ever before. If you look at the actual disposable income, it is shrinking. If you look at the savings rate, come on, 5%. This is nonsensical, the way that people do not save their money. And you could say, well, they're investing their money. They're not really investing in many things. Look at what people do with their money. They burn it. That's what they do best. If there was a competition for waste, then it would be fantastic, because that's what people are doing. They spend it on senseless things for the most part. Yes, we do have people that are investing in assets, but that's a small minority. That is the top 10% ultimately that have been benefiting from this, and then the higher up you go, obviously the more benefit it has been over the years. Most people don't own the assets. That's the fact. Whether that's stocks, whether that's real estate, businesses, and so on. There's more data in here, but essentially this is really what I wanted to show you to lead into some other things that I wanted to bring to you today. This mirrors the industrial production month over month as well. You can see basically not looking very good over the last few months. This coincides with everything else I've been bringing to you since the end of the year. Pretty much in 2018 we've had weakness. US motor vehicle production has declined significantly, but over the past couple years that has been ramping up. This of course comes at a time when we've got a problem going on within the United States with all of these different vehicles. Look, they're not going to be making cars in the US in the future. That's going to be something that is just so rare. Why would they do so if they can make it in another part of the world and people can bring in the cars that way? This is probably going to be the future of, services in the Western economies, and you have all the production taking place in the developing world, it's significantly cheaper. All of these companies care about is corporate profits. They don't want to pay healthcare. They don't want to pay benefits. So what do? Well, they offshore jobs. Even if you have to pay tariffs, even if you have to pay taxes, it doesn't matter. They're always going to benefit by offshoring the jobs. So we have to give more incentives. Well, that's a whole different story. Not going to go down there. Worried a recession is coming, U.S. online lenders reduce risk. I thought this was really interesting. This article out of Reuters touched on something that I don't really cover often. I hope that you've been paying attention to it, but it's so important. I wanted to show you it today, and we'll talk about it just for a second here. U.S. online lenders are scrutinizing loan quality, securing long-term financing, and cutting costs. Why though? Think about this. Why are they doing it? The economy is apparently getting better. Stocks are getting better, right? Well, check this out. The executives prepare for what they fear could be the sector's first economic downturn. That's right. That's what we're talking about today. A recession could bring escalating credit losses, liquidity crunch, and higher funding costs. This is what they're talking about here. We're talking about these companies that have a lot of money, they're dealing with money, and they are worried about what's happening. Why? The stock market has risen considerably. We have seen all of the media projecting that everything is doing well now. It's doing better than it has been over the last year, over the past 2 years. That's what we're being told. And yet all of these different signs have come up. Well, take a look at this further. This is very top of mind for us, referring to the possibility of a recession. It's not a question of if, it's when, and it's not 5 years away. At the bottom, we were seeing economists bringing up some warning signs, and we were following the Fed signals and that they were becoming more dovish. We wanted to be prepared and ready. So there are some individuals out there, big corporations, small corporations, and analysts and so on, that are warning about this information. All I'm doing is collecting this data, aggregating it, and showing it to you, because if you just look at the media, if you're watching the New York Times, you're looking at CNN, you're looking at this, you will never be able to understand what's happening because of this data aggregation isn't taking place. This is when you look into it deeper, you start to realize that. I had read Austrian economics many years ago, and that started me down this really trip that I was on, looking for the real deal. What's happening? What is really behind the monetary system? When you go through school, you find out, most people find out nothing, but even if you're looking into economics, you're not going to find how to actually disclose what the financial system really is behind the scenes. And then you start digging in and you realize, wait a second. This is how it really is built. This is what's underlying this system. Most people have no idea, but if you search for yourself, I know that you will understand. You will really understand, and you're not going to be too happy about it. Since the last recession, non-financial corporate debt has ballooned to more than, check it out, $9 trillion as of November 2018, which is nearly half of the US GDP, as you can see in this chart. Each recession going back to the mid-80s coincided with an elevated debt to GDP level. Okay, here we go. Every single time this happens, no need to worry about it because this time is different. That's right. Don't worry about it. No reason to worry. This time is certainly different. Well, I'll leave that up to you. Corporate loan delinquencies have surged following rate hike cycles, but don't worry because the rate hike cycle is over, apparently. Well, they're talking about this. Will they hike? Will they not hike? Many people believe that this was it. That last hike was the end. They're not going to do it anymore because they're really worried. If that's the case, well then, we are only expecting one thing to happen, and that is where we see the next recession. That's really the way it is. On the way up, you don't have recessions that occur. It's always as they start to bring the Fed funds rate down again, that's when they're in the panic mode. So we'll see what happens. Looking at the US household net worth as a percentage of GDP, this has gone far beyond where anybody ever predicted it could get to. We've seen the zero interest rate policies all around the world, even places that never got down to necessarily zero. Maybe we're looking at, let's say, Australia, for instance. They actually brought interest rates down afterwards, not even during the financial crisis, but following that, they realized the global economy is really slow. We have to react accordingly, and then that just expands the assets further and further. But what happens when something grows too big? It ends up popping, it ends up forming a bubble, and of course we know what will happen as a result. Now this is one company here, Dollar General, that is opening stores. I talk about the closing of stores, but look at the vast majority of stores that is opening today. I'm often criticized for the episodes I do about store closures, and they say, well, you're not pointing to the stores that are opening. Here you go. Here's some information for you to read and weep. Dollar General will open 975 stores this year. So out of the 2,700 stores that are opening, I believe that's the number, I'm going from memory, 2,700 stores, nearly 1,000 of them are Dollar General. Now, there's nothing wrong with this company. I don't know anything about this company, in fact. I believe it's all in the US. I don't know if they have any in Canada. Regardless, all I know is that when people are going to dollar stores, they are generally looking for a cheap price. They don't want to spend the money. What does that tell you about what's happening, about people's disposable income? It's shrinking. If people had an abundance of money, they wouldn't have an issue. They'd be spending money everywhere, but that's not the case today. More dollar stores are opening and less of the other types of stores. We see the closures happening. We're always talking about retail this, retail that. Look at the reality of the situation. When you break down the facts, it all makes sense. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a like on this video, you are supporting me. You're getting the real deal that is not brought out there in the media anywhere. So I do appreciate when you do that. If you want the financial education you were not taught in school, these two books have everything you need. Check them out at the links in the description. Audiobook is available at themoneygps.com. If you want to find out about the 6,000 stores that are closing in the US in 2019, click on this video. It is so important, and I will see you there.